The next panel is about enhancing the security of stablecoin and RWA lending. It is moderated by Nate, founder of Token Dynamics. We have speakers Alessandro from Dialectic, Michael Bentley from Euler, Yaron Bellner from B Protocol, Nick Kunkel from Chronicle, and Chris Carapola from Curvents. Welcome our speakers, everyone.
Hi, everyone. I'm Michael. I'm the co-founder and CEO of Euler Labs. Euler was a lending protocol that was started back in 2020 during the pandemic, and by 2023 was the third largest lending protocol on Ethereum until an unfortunate incident in that year brought it to a halt. But yeah, this year I'm very pleased to announce that we're back with a bang, and we just announced a V2 version of the Euler platform. It's a modular lending protocol that we'll be launching in the coming months. So very excited to talk more about that. Thank you.
Hi, I'm Nicholas Kunkel. I'm the founder of Chronicle Protocol, and we're an Oracle protocol that spun out of MakerDAO a couple of years back. Fun fact, we were actually the first Oracle on Ethereum when we went live in May of 2017 for ProtoSci, which was like the prototype, like precursor to DAI. At our peak, I think in the last cycle, we were securing almost $22 billion in TVL, and currently we're securing $10 billion in TVL across a multitude of DeFi protocols.
Yeah, hi everyone. I'm Alessandro. I'm with Dialectic. We are an asset manager and we do liquidity provisioning in DeFi. So we provide liquidity to all sorts of DeFi protocols and opportunities, and we work quite closely with a bunch of different protocols to do targeted liquidity allocation to key pairs, and we just try to generate yield in a fully on-chain manner.
Yeah, hi everyone. I'm Yaron. I'm from B Protocol. B Protocol is an economic risk management protocol where our vision is to try to take the human factor as much as possible out of the equation, where the advantages for that are kind of twofold. One, risk management today is super political and has a lot of human bias, both from DAO politics, but also marketing, business, etc. And I think these days DeFi lending is very notable in the sense that it's very different from most of the DeFi protocols and from the DeFi ethos, and potentially not what we would imagine and want DeFi to be. And the other advantage there is that by removing the human factor, costs are much more affordable. These days, protocols spend ridiculous amount of money on risk management, and the outcome is both political, both very expensive, also non-scalable. You cannot really manage, like thousands of assets, etc., etc. So yeah, that's me.
Hi, is that good audio? A lot of familiar faces here. I'm Chris from Curvents. We've been building Curvents for around 2 years now, 22 months. We're what I would call a modular multi-chain money market for yield-bearing assets. So that's everything from LPs to real-world assets to liquid staking, liquid restaking, everything really under the hood. So we're really excited to be bringing this to market probably Q2 of this year. And yeah, just looking to really push DeFi forward. We're going to be open sourcing the code base and looking to build the future here.
Awesome. Thanks everyone for the introductions. What I love about this panel is everybody has a very unique and specialized expertise. Everybody's got expertise related to lending protocols, but I'm expecting a few categories of risks to come up in this next question, which is what risks do you see for on-chain lending protocols? What keeps you guys up at night?
I mean, yeah, the elephant in the room probably. I mean, smart contract risk. I'm going to put that throw my hat in the ring for that one. It's quite an important one. Yeah, it's really important to secure smart contracts, and extremely difficult to do so. As we found out, we were a really security-oriented team at Euler Labs, and the V1 of the protocol was extensively audited We had the largest bug bounty of any lending protocol on Ethereum. We used formal verification, all the rest of it, and in spite of all that, yeah, we found ourselves that in March of 2023, an exploit brought the protocol to its knees and drained users' funds. Now, we were with a lot of hard work, we were able to recover all the funds, and that's part of the reason why we're still here today, about to launch V2. But yeah, it was a harrowing experience, and it really highlights how challenging securing, smart contracts can be. I think overall, DeFi as a whole becomes sort of anti-fragile because protocols that get exploited, that have holes, end up kind of dying, and the ones that survive generate a so-called Lindy effect, and you can actually kind of prove that they're verifiably secure because they haven't been hacked, and that process just takes time. And so I think that's kind of a big plus for DeFi as a whole in the long run, but the process by which that security comes about can be quite brutal.
Right. Thanks, Michael.
Yeah, I mean, clearly, I think smart contract risk, right, is the elephant in the room. If we go like one layer of abstraction deeper, I would say kind of the liquidity profile of assets. I think when someone like Maker or Euler or Aave, right, or Compound, right, onboards an asset, there's usually some kind of like risk analysis done, right, on what is the liquidity of a certain asset, what is like the maximum drawdown in a tumultuous kind of situation, what is the maximum debt exposure that the protocol wants to this particular asset. And so after this kind of like research like profile is done of this asset, right, there are certain kind of numbers that could spit out, right, and those might be like an interest rate, those might be a loan to value kind of like weighting. And the problem here is that these characteristics of assets are quite dynamic. They're not static. But I think there's a risk on the protocol side, right, that we don't update them frequently enough to essentially reset or recalibrate the risk parameters according to like the real-time dynamic profile of this asset. And I think on the more conservative lender side, like I would say Maker is quite a bit more conservative in what we add and what kind of leverage we allow people. But on the more extreme side, you have people who go after the long tail more, right? And they do this because like there's users who want this, right? And they see their ability to build out a user base in this way, but it's also the most riskiest, right? Those are like the ones whose profile changes the most, and so this is a significant risk that I don't think is like acknowledged enough.
And specifically, would you call this liquidity risk, or are you speaking to the broader profile, the asset?
I would say it's like the broader risk profile of an asset, but I think liquidity factors in significantly.
Mm-hmm. Great. Thanks, Nicholas.
Yeah, no, I totally agree that the smart contract risk is the most relevant one, and also just historically speaking, funds lost in DeFi, the majority of that was due to smart contract exploit. It is a very broad attack surface, and it's very difficult to contain the risk in that. For some of the like economic parameters on the lending protocol, that's like a smaller set of information that needs to be analyzed, and it's a lot more contained as an attack surface. And also those things don't happen instantly, whereas usually a smart contract hack, that's like one transaction and the money is gone. So both on like a preemptive security analysis of protocols, but then also being able to react to the risks manifesting, it's much more difficult to manage.
Yeah. So maybe replying to Nick, I think like liquidity or risk profile, or more generally quantitative risk profile, is maybe one of the fewer aspects that actually, I don't know, kind of able to actually manage. And risk could happen, obviously, but you can update parameters as frequently as you want, right? Obviously, there's some UX implications, etc. But I think it's one of the kind of risk aspects that are kind of heavily investigated and handled by serious teams. Of course, you do always have these protocols for 2DGN, etc., but also typically with quite limited effect. What keeps me at night is more the systemic risk, which of course is mostly manifest by smart contract attacks. But to be more specific, what keeps me up at night is, like Oracle issues, maybe stablecoin issues, bridge issues, and stuff like that. Where there are also the solutions and mitigation. So typically for liquidity risk, you do have loan to value that kind of mitigate it. For systemic risks, the most you can do is limit the exposure, and typically it conflicts, with some business logic there. And maybe another nightmare is of course Lido getting hacked, etc. Right? So in theory you do have system, like you limit exposure, etc. In practice, growth and BD dictates other strategies. That's what keeps me up at night.
I think a lot of people talked about smart contract risk mainly here, which I think is obviously fundamentally the biggest issue. But I think, as I think about how we want to support things, where we want to go, chains, bridges, all these things, you have like the total addressable market that you want to hit. You want to support as much stuff as you can, as safely as you can. And the more stuff you support, the larger your kind of risk profile, right? So you have, do you want to tap into real world assets or liquid staking, liquid restaking? Like, as you said, does Lido get hacked? Do you just support regular ETH or liquid staking? So for me, I think there's like this kind of spectrum where you want to support as much stuff as you can, as safely as you can, as scalably as you can, and collaborate with as many people as you can and get those kind of like what I would call 1 + 1 = 3 scenarios. But you need to stop at some point. You can't just support everything. You can't support, the latest and greatest meme coins and, the longest tail LP profiles and stuff like that. So for me, as we're deciding what we want to support, it's like, where do we stop, right? Because we've already taken on so much and built so much. Do we just try to support everything? Do we stop 75% of the way there, 50% of the way there? And do we kind of bite off more than we could chew? So, that's what keeps me up at night for sure.
And there are all these types of risks. So we've heard smart contract risk, Oracle risk, asset risk. There are a lot of different risks that lending protocols specifically need to be thinking about when they're designing. How do we even go about assessing and evaluating these risks? How do we even prioritize them? Michael, if you want to start.
Well, I think there's, I wrote an article recently about the different types of risk management that exist out there, and I sort of broadly divided things in two. One model of risk management is the sort of paternalistic risk management, where the protocol or its risk management associates actually actively manage risk on behalf of users. And in that context, I think the priorities there are focusing on the external economic factors and how they're changing through time, and trying to dynamically update parameters to ensure that the risk of bad debt is sort of minimized. The alternative model is the sort of free market model, where the invisible hand kind of guides things, and you see users, individuals actively moving their funds in and out of pools with different risk management, risk parameterizations. I think there the same sort of challenges exist, right? The priority is to minimize your exposure to bad debt, but you're really then taking into account that the efficiency of that system, and that you have to actively manage it and be kind of on the ball monitoring. You have to have extensive monitoring systems of your own, and so the priority then comes down to the individual's responsibility to actually manage that.
And you mentioned these two models, paternalistic and free market, were the terms used. Can you give a couple examples for the audience just to put some faces to names in that sense?
Yeah, sure. I think, probably the biggest example of a paternalistic model will be Aave and the Aave DAO's governance of the system. They've relied on risk managers like B Protocol and Gauntlet and Chaos and others essentially to dynamically update loan-to-value ratios, among other things, as economic conditions change. And users in that protocol sit there passively, right? They expect to be able to just deposit and allow those parameters to change to keep them safe. One of the earliest models of sort of free market would be something like Kashi that was brought about by the Sushi Swap developers, but the more modern sort of examples probably things like Ajna, where they have a purely Oracle-free isolated pools. Morpho Blue would be another example of this. There's Fraxland as well. Here you have, one of the issues there is potentially more liquidity fragmentation, but ultimately your users have the freedom of choice to be able to deposit into isolated pools. And of course, I'll just mention that Euler V2 is coming soon, and I think, the modular nature of that protocol will actually support both different risk models and allow the users the freedom of choice whether they want more of a paternalistic hand-holding kind of risk management system, or they want the freedom to dynamically adjust their own allocations.
Awesome. Thanks for sharing. I think that's a really helpful mental model. If the audience hasn't read your article, I would recommend they do that. It was great putting words to terms that I think all of us think about when we're thinking about lending protocols and the different architectures, but it was a concise way of putting it, paternalistic versus free market.
Thanks.
No, I quite agree with that interpretation. I think the risk is more on the user side, where I think the protocols have been quite clear presenting themselves as, we are paternalistic and managing risk on your behalf, right, to some extent, versus, you're managing risk on your own. So I don't think it's a awareness problem from the protocol's point of view. I think they're trying to do that as best they can. But I also know that, it definitely seems like we're entering into this next cycle. There's going to be an order of magnitude of new users kind of coming in, and they're going to learn as best as they can and get onboarded quickly. And I'm not sure they're going to appreciate the respective differences between these protocols. And so I think the risk is, that the protocols have set themselves up the way that they've set themselves up, right? But people may not use them in the way that they expect, right? And that can lead to consequences in the market, and those may compound, right, and lead to kind of unexpected scenarios.
Definitely. Unexpected scenarios, you want to elaborate on that? Like maybe historical examples? Are you thinking highly profitable trading strategies or like systemic collapses? More like cascading liquidations and the like, where, let's say like you have like a pegged type of coin, like you have like everyone seems to be calling out Lido, so I'm not going to call them out, right? But some other like ETH, staking derivative, right? Price versus ETH, and there's no reason why that ratio should really depeg considerably, given that we have the ability, right, to unstake and cash out one for one. But there are discontinuities that can happen, and they can be triggered by, seemingly inert events. Like Silicon Valley
like for
Bank's,
example,
Silicon Valley Bank's insolvency, like macro events.
I would not classify those as inert events. Like,
Fair.
but yeah.
Yeah.
Right.
Okay. Great. Thanks for elaborating, Sandro.
Yeah, I mean, I agree that the burden should be placed more on the liquidity provider or the user rather than the protocol. I mean, different protocols have different design philosophies, there's different approaches. It's an open and free market, and ultimately it's up to the liquidity provider to do their own due diligence, to understand what risks they're taking, and then allocate capital based on their independent risk assessment. And there is some lindiness to the different protocols, of course, like things that have been proven to work for a long time or likely gonna work in the future. But yeah, I mean, on the liquidity provision side, like we really look at like the risk frameworks and the risk management that the protocol sets in place. But then we always need to like update our view and update how it compares to the other places. and ultimately shift liquidity to where the best risk-adjusted return sits. And in terms of upgradability of protocols and parameters, there is always a bit of risk that if the protocol is upgradable and if the parameters are upgradable, then that kind of forces us as liquidity providers to monitor those parameters in real time, and then also react in case something changes. And that could mean that if some risk parameters change, we have to withdraw liquidity, redo the due diligence, understand what changes, understand how the risk profile changes, and then if we feel comfortable, redeploy. So I think that's something on the protocol side to also consider, kind of like how are the liquidity providers perceiving the risk of the protocol, and kind of think about it in that sense as well.
Yeah, so our approach, what we try to kind of push forward is the separation between objective risk and subjective risk, where the subjective is both where the politics come, but also kind of personal beliefs and assumptions, but also I think most of where the money is kind of spent in risk analysis, where it shouldn't necessarily be the case. And like a simple example here is maybe Chronicle versus Chainlink, right? If you look at the objective data, so maybe like very similar Lindy. We look at the kind of historical deviation. I assume we'll get like very similar numbers. But still, like Maker prefer Chronicle, right? Aave prefer Chainlink. There, kind of no objective data to support it. And obviously, I can, write and also charge a lot, writing 20-page number on why this is better or why that is better. And to be honest, this is, I think, like most of the work these days of risk analysis is around that area, where at the end of the day, eventually it's kind of should be the decision of the DAO or community, what they prefer, or even if of the end user, if applicable, if you really have this granularity to decide. And this is not happening, and like instead there is this paternalistic approach where you kind of pay external vendor to tell you what your subjective opinion has to be. And there's this, kind of objective opinion of, so like in Oracles you can just measure deviations, but for assets in general, you can measure liquidity, volatility. And in traditional risk management work these days, these are kind of, they're coupled a lot. At the end result, you don't really present to the user, what stems from what, whether it's subjective or objective, you just mix everything together. So like kind of our approach is to separate between these two, let either the user or the DAO kind of set this subjective risk appetite they want. On top of that, build the objective layer, and then eventually, based on the risk appetite and objective data, output a recommendation. And other than being more scalable, it also kind of put like the risk level that the protocol choose, like very straight into the user face, right? Where right now, subjective and objective analysis are very much coupled and mixed together without any clear presentation of what is what.
Yeah, it's kind of like a blending of the two approaches of paternalistic and free market in the sense that you're offering an option to the users but not forcing or choosing for them. Chris.
I have two things I'll speak on for this. The first is on the permissionless side. So when I think of smart contracts, they're essentially these state machines, right? You have states that change and these smart contracts interact. And when we think about permissionless nature, you're talking about very small systems, but also very large systems. I would consider a lending market to be a very large system. So when I think about something like wrapped ether, I think that's something that should be immutable. But when you get to these very large systems, it becomes very hard to have a permissionless configuration that's, whether you call it Lindy or evergreen or even competitive. I think that's a little more challenging. So I lean a bit more to what Michael described as the parental model. But what I will say is that I think some dynamic, state-dependent systems are incredibly important when you do that, because a lot of parental models will take place over weeks or months or years, and the volatility and the market from today to tomorrow to next month to next year is very different. And you're really optimizing for two different things. You're optimizing for the low volatility periods as well as like the heavy volatility periods, right? So when the market is quiet, but also when massive news comes out, like the ETF, for example, for Bitcoin, that drew a lot of volatility in. And you want to make the markets attractive to both the depositors that would borrow, but also the lenders that are taking essentially the other side of the trade there. So you need to be both kind to the depositor, the borrower, in periods of low volatility, but also be able to offload that risk and protect the lenders in periods of high volatility. And I think that's really hard, even with definitely a permissionless model, but even with a permissioned model. Because if you're talking about volatility that pops out in 5 minutes or a block, you don't have time to really adjust those things. So if you can, I think the parental model is the right direction, but I think having those dynamic systems that can handle those changing states, I think helps a lot as you look at the parental model.
So I just really want to comment on that. Like, I think that you touched on something really important, right? That even in the parental model, you need some form of, automation to almost act as like a circuit breaker, right? Because humans will not be able to react in time to enact the protections necessary on the system. And I think oracles can actually be really useful in this respect. I think oracles are kind of underutilized in the sense that like everyone kind of, when I say the word oracle, just assumes like it's going to give you the price of an asset, but they can really report to you, any like external function of state. And so an oracle is not always the right answer, right? There's, things that you can easily query on chain to trigger a circuit breaker, right? That doesn't require, trusting an oracle. It just maybe requires like an external trigger. But when you start doing things that are, dependent on cross-chain or dependent on external data, an oracle is absolutely appropriate, right? And in terms of a circuit breaker, right, there's usually, like compared to the damage that a malicious oracle can do with a bad price, right, the damage that you can do with respect to a circuit breaker is actually rather limited. And so I think it's rather underutilized for that purpose.
I think you're spot on with that. I don't want to shill a lot of the stuff that we're working on. But
I'm obviously incredibly biased.
Yeah,
right?
yeah. But I think from my perspective, 100% agreed. I mean, one of the things that was really important for us was like what I would call like, don't trust, verify. Right? So you can use these oracle prices and such, but we, for example, look at a dual oracle model where we essentially use a pessimistic version that the collateral uses the lower of the price and the debt uses the higher. And if those oracles deviate too much, then it starts pausing things, as you said, circuit breakers. And I think it's hard to gauge those numbers, and I think groups like B Protocol would be incredibly helpful in that. But I think if you add those systems in that help those kind of tail scenarios, you exponentially improve the security of those models and what you can support. Because otherwise you're going to be constrained to the lowest volatility, as you said, most lindy and the most liquid assets, and then it becomes a very crowded market, which is great. I mean, having a lot of options and competition is what moves the industry forward. But I think expanding what we can do requires a little bit more, kind of strategic dynamic systems, and making it flexible, I guess, for the different states is really important. So a lot of respect to you guys on the work you've done on the Oracle side, and yeah, definitely agree on using those circuit breakers.
That's a cool way to think about oracles as well. As they can provide any data. It's not just data about the liquidity or the risk of a particular asset. It's about what information needs to be fed to the lending protocol, and if that's turn off because there's this massive systemic risk of cascading liquidations happening, then that's going to help the protocol survive long term. So everything that's been mentioned here kind of gets to our next question, which is talking about actually I'm going to gloss over this in the interest of time, but I wanted to talk a little bit about the difference between designing immutably, designing protocols to be immutable, and designing them to be upgradable. We've kind of covered that, but in light of that, and in light of everything that has been discussed, do you guys think DeFi can interoperate with real-world assets in traditional finance? And how does the introduction of real-world assets change the security assumptions of lending protocols?
Yes, I definitely think they can and they will. I think you'll see a lot of that happening in the next few months. Actually, I think it'll be a massive market. One of the biggest concerns or challenges with real-world assets is often that they come with additional restrictions and checks and balances. So, for instance, some real-world assets will have secondary transfer restrictions. I can't just permissionlessly send from A to B. The user might have to have some compliance checks or be on some whitelist. And that plays an important role where you need to liquidate those assets, because you can't just rely on a permissionless open liquidation system. You then have to have whitelisted liquidators involved in the system as well. And so, yeah, having liquidity available and be able to perform those liquidations is a challenge, and also understanding the prices of those real-world assets. Normally, we rely on prices from DeFi itself, so on-chain trading activity. In those cases, you might need to actually take prices off-chain from some traditional finance exchange or wherever else, or some bond market, and then put those on-chain. And of course, that introduces new trust-based assumptions. So, a couple of challenges there.
Definitely, yeah. One of those being the Oracle problem. Nicholas.
Sure. So, I think it can be done. I think Maker is doing it very successfully right now, right, where I think they're making around $230 million in revenue, and about 50% of that is coming just from real-world assets, right, and the other 50% is coming from crypto-backed loans. I will say I think the implementation of them today is quite rudimentary, especially with respect to the risk that they present. Integrating an RWA into a lending protocol or any DeFi protocol is significantly more complex than integrating a crypto native asset. I would say like a good in-between step of a crypto native asset and an RWA is like a bridged asset, right? Where you have the real asset, sitting in escrow on some bridge in some chain somewhere, right? And you have a wrapped version of this asset that is a claim on the original asset, floating around on another chain, right? And then that becomes integrated into a protocol. And I think the last couple of years, right, DeFi protocols have had to deal with like, how do you manage that situation? And what are the different kinds of risks, and what are the checks and balances that you do? And so with RWAs, it's just like another order of magnitude, kind of in terms of complexity. But again, I think oracles can help a lot, not just with things like price, but with a lot of like auxiliary metrics that are going to help DeFi protocols deal with those risks.
Great, thank you. Alessandro, Yaron, and Chris, we have 45 seconds left. I'm guessing we can go slightly over, but
yeah,
a couple bullet points would be great.
Yeah, I'll be very quick. I mean, I fully agree that it's going to introduce a lot of complexities, and usually complexities are not great for reducing risk, because as there's more complexity, there's more attack vectors and more things that can go wrong. On the asset side, I mean, as liquidity providers, I'd rather have exposure to some asset that I can redeem for something real, rather than some fractionally collateralized stablecoin or something. So from that point of view, it's great that we have more assets that we can play with and deploy into. But again, like all of these assets will have a lot of restrictions on transfers and KYC and things like that, which just adds a lot of layers of complexity, and all of these layers needs to be analyzed and assessed, and it's gonna be fun in any case.
Yeah, so maybe like quick few words. So yeah, I think in general it's like a huge systemic risk. I think right now it's people underestimate it. I think like in the coming few years we will see few wrecked events. Then we can maybe analyze it better. But yeah, but the fact that it's huge systemic risk does not mean we cannot handle it or integrate it into DeFi. there are already so many other systemic risks, so it's just another one.
I'll be brief, but a lot of already good stuff said on this. I'll talk about more of the liquidity side. When you look at like very liquid stuff like short-dated treasuries, I think it's very easy because they're essentially treated like money. I mean, a lot of stable coins today are basically real-world assets under the hood, whether they give the yield or not. But when you start looking at these like kind of longer dated, heavier duration risk things, I mean, you look at a house, you look at 30-year treasuries, my background's in traditional finance, so I used to price a lot of like very liquid bonds, for example. So how do you price a bond that hasn't traded in 2 weeks? It's very hard. So I think when you start looking at those like kind of longer duration things, like less liquid things, you have to move away from the more typical pool model to more of like a peer-to-peer model where it's more of like an agreement, like you will, either they'll pay back this loan or you get the thing, whatever the thing is. Because it's just so difficult to really price that your lenders almost become exit liquidity, right? If the price moves against them, if there's some distressed debt or something, they could just get taken for a ride in this like real world MEV, if you will. Yeah,
a couple things came up here. I think the illiquidity of these assets and also the idea that you could use an escrow to better wrap that asset to manage the risk. I think these would be really interesting and I would love to dive more into them, but we're out of time, so maybe just a few quick words. Where can people find you guys to follow more of your work?
Please visit Euler Finance or follow Euler Finance on Twitter, X.
Yep. Our website is chroniclelabs.org, or you can find us on Twitter at chroniclelabs. Thank you.
Yes, our website is dialectic.ch, and on Twitter it's dialectic_group.
So bprotocol.org, and on Twitter bprotocolis.
Follow Curvance everywhere. Curvance on Twitter, curvance.com. We'll get you like messages by carrier pigeon. Curvance everywhere. So we'll be live in Q2. Excited to build with all these great guys here, and looking forward to building the future.
Awesome. Thank you, guys. And I'm Nate. You can find us at Token Dynamics on Twitter. And thank you to all the panelists. If we could get a round of applause for all these guys.